This is the current federal tax developments for the week of September the 16th, 2019. Current federal tax developments are brought to you by Kaplan Financial Education and your state society of CPAs. This week we're going to look at really only three issues. One will be a case involving a high school student who won a prize and then discovered there's going to be a tax to pay. And then two of the developments relate to proposed regulations the IRS put out regarding changes made to Section 451 as part of the Tax Cuts and Jobs Act. These are proposed regs we've been waiting on for a while. They came out, well, just before the due date for the pass-through returns, and I guess a whole month before the due date for C Corporation calendar year returns, so maybe we should feel good about that. But we'll take a look at those issues today, see how things are running, and then talk about some other things that happened this week, including, I should mention, we will not be covering the final and the proposed regs on bonus depreciation. Those came out on Friday, another thing that came out just before the due date. We'll probably talk about those in more detail next week. The one thing I will tell you right now, though, is if you were hoping that those regulations would be the excuse for the IRS to change their mind about the treatment of qualified improvement property and decide that it should qualify for bonus depreciation, that did not happen. The IRS stayed with their position, stating that tough luck, Congress has got to change the law for that to happen. We need a law change, not just a change in our regulation stance. We still believe we can't do it. But we'll cover that in more detail next week. I want to remind you that we do have coming up on October the 16th, we're going to have the first of our rebroadcasts from Cal CPA. This is a rebroadcast of a session that was done in Albuquerque. And I'm going to mention it here because Cal CPA's rebroadcasts are also picked up by a number of our participating state societies. So if you take a look on October the 16th, we'll have a course, Advanced Partnership Issues. That particular course, I did the presentation in New Mexico. We'll be talking about it that day, talking about all those issues, new partnership audit rules, all those other fun, neat things. That's coming up, as I said, on October the 16th, in case you want to just go dive straight into your CPE immediately after we finish up our extended due date returns for individuals and C corporations. We have CPE for you beginning that day. We also have a lot of other CPE coming up later, but we'll talk about that later. Let's go to our first case of the week. This particular case is a case of Conyers versus Commissioner. It is a designated order. You're not going to find a traditional published case. It is on the orders pages of the tax court. We have the link in the materials. It is case number 1369-18. It was decided on September the 11th of 2019. This particular case involves a high school student, Alejandra Conyers, and the issue was she had perfect attendance her senior year. She also had gotten good grades. Now, a car dealership in her region in Tennessee had created a drawing for high school seniors where they would give them a compact SUV, a Jeep compact SUV would be given to one of the high school seniors who won the drawing. Alejandra won the drawing. So she obtains this, and there's coverage in the local paper. And it's still actually on the web. You can actually go find out all of this stuff about her win. Interesting story on that side of the effect. But the problem we run into here is what's the tax impact of this? And initially, some of you may be thinking, well, this is easy. It's a prize. Prizes are taxable. And ultimately, that's the answer. And the real catch, though, is the opinion actually goes through some history here. And you'll discover that prior to 1986, this would not have been the answer. So, for instance, I graduated from high school before 1986. Had a car dealership in my area been, handling a program like this, and had I qualified for entering into it, and had I been drawn, I would not have paid tax on this particular award of a car. That would have been back in 1978. But in 1986, Congress changed the law. In fact, there were a pair of law changes that are dealt with here, one of which dealt with the general treatment of prizes and awards, and then the second one, which is the 86 change, that made a change to the change. And that change is what actually ends up causing Alejandra to pay tax on the award of the car. So we'll talk about that particular issue. So again, she wins her case in the drawing. It makes perfect sense. She argued that in fact this should be a gift. Now, a lot of us are thinking, well, we always have that. They always think it's a gift. And yeah, we know gifts aren't taxable. But, this isn't a gift. This is a prize. That's true. But there's a catch here. Back before the 54 code was enacted, there was a similar provision in the 39 code that said gifts were not taxable. And there were a series of cases, one of which was Washburn versus Commissioner was the key one, that found that if you in fact won a prize and you didn't enter a drawing, you in essence, you didn't do anything to enter the drawing. You did nothing. You just were randomly picked and won something. The taxpayer in Washburn got a phone call from a radio station. She'd won the pot of gold. That was a cash prize worth $900. She did nothing. She was selected randomly out of the phone book. She didn't have to do anything for the radio station, after receiving the prize. The court found that that met the definition of a gift because Section 102 tells us, of course, that gross income does not include the value of property acquired by gift, bequest, device, or inheritance. And in this case, Ms. Washburn did nothing, right? She just was sitting there, got a phone call, and had $900. The court said, well, that looks like a gift. The radio station was no obligation to give Ms. Washburn $900. She didn't do anything to earn the $900. She didn't have to do anything afterward to keep the $900 except cash the check. So it wasn't taxable. Congress didn't like that because first thing is it became interesting deciding whether somebody had done enough to have a Washburn situation or whether in fact they were basically had done too much and therefore had kind of done work to receive the prize and it was taxable, no longer a gift. So in 1954 Congress removed that. Congress kept the gift rule in place, but in the 1954 code they added Section 74, which made prizes taxable. But part of the original Section 74 as part of the 54 code told us that in fact it would not count if you were if you did nothing, you basically qualified like Washburn, and the recipients were not required to perform any additional work, and you received it for educational achievement. There were a number of other things you could receive it for, but in this particular case, educational achievement. So 1954, even though we got rid of Washburn generally, Washburn would have applied to Alexandra, and Alexandra, who did nothing, right? She got the grades. She didn't enter this contest. Her school just gave the car dealership a list of people, just like the phone company gave the radio station a list of people with phones. The car dealer just, basically her school just gave the car dealer a list of students that met the criteria. The car dealership drew Alejandra's name out of the pot. She had no requirement to perform any more services for the car dealer. Voila, under the 54 version of Section 74, would not have been taxable. Apparently, redoing the code causes Congress to revisit this. That's the only time we seem to do so. And in 1986, Congress again changed the rules. You may remember, we now have the 1986 code. So we had the 54 code, the 86 code. As we go to each code, we seem to swap this a little bit. Under the 86 code, Congress put a couple of strings on the rule where you receive this award for educational achievements and educational or other achievements. It covered all the various types you could receive it for. And in this case, what happens is you have to immediately transfer the prize to a governmental agency or a charitable organization. If you do that, good news is you don't have taxable income because we know today probably Alejandra probably didn't otherwise. She's a high school senior. She's working at Chick-fil-A. She probably didn't have a whole lot of income. I doubt she was itemizing otherwise. So today, she might get a car worth $24,000. Well, she's going to lose about half of that deduction simply by having the standard deduction. So it's like, we don't want to have her have to include that in income. So we decided that, in fact, if you did that, these people don't have to include income. It was a worse problem, actually, back when the standard deduction was lower. At least now the standard deduction is higher. Kind of a different issue. But basically, she doesn't have to throw it in income. It doesn't cause her AGI problems. We also know that AGI can cause her other issues. So she could exclude it. But she didn't transfer it to a charity. She didn't transfer it to a governmental agency. First thing is, it would have been odd to do it. Second thing is, as you would find out if you go look at the history of this, and it was pretty easy to follow up the story because, we know who she was. We know she won a car. There's only some people that's happened to who are high school students in Tennessee. So, the stories, and the local paper wrote up a nice story about her. her car was in trouble and she needed a new car. This is a really nice car. She got the car in 1 year's worth of insurance, which if you've had, if you've been around teenagers and seen insurance, that's also not a small deal to get a year's worth of insurance paid for. So yeah, it worked great. Problem is, it's includable in her income. Now, they did try and she was represented by basically a legal aid group. And they did try at court to say, well, okay, otherwise it really wasn't worth the $24,000 that was on the 1099 miscellaneous. And that's an argument we've seen before. It's an argument that lots of people try with prizes. In this case, though, the court said the mere speculation, and yes, we quote unquote all know that a car is not worth, that $24,000 list price Jeep SUV is not going to be worth $24,000 when you drive it off the showroom floor. It's going to drop to a value significantly below that. And while we all know that, the reality is they didn't establish any reason why the value of the car would be less. And again, it's tough to say that the drive off the lot price is the real one, largely because the car she got hadn't been driven off the lot yet. And it would have cost her $24,000 to take it over. But in any regard, that issue was not decided in this case. We decided the other issue. So again, interesting history of the code section. It also tells us something I think important about our tax research. Section 102 clearly does, which Section 102, we've got all kinds of history, would have excluded this. Here's our problem. That's a general code provision. So we kind of want to follow the pecking order here. Section 61 says basically access to wealth, gross income, is taxable. Section 102 puts an exception to that. Again, more specific gifts, if that's your nature of your accession to wealth, are not taxable. More specific provisions override less specific. But now we're going to go on a step further. In 1954, we added a rule for prizes and awards. That created an exception to the Section 102 rule. And so it said, since it was a specific, if your gift was a prize or award, then you had to pick it up as income unless you met the special criteria, which involved getting it for like educational achievement. In 1986, we then modified that exception again, saying, well, even the educational achievement one, now you've got to give it to a governmental agency or you've got to give it to a charity. So you have to follow the line. 61 tells us it's in. 102 says, nope, it's out. 74 says, oh, no, it's back in. So you have to follow that whole chain when you're doing your research to make sure you've got the most specific code provision covering your situation. In this case, obviously, the gift was not the proper stopping point. Section 74, as it existed in the law when Alejandra, won this particular award. And I'm almost sure that Alejandra probably, she probably goes by a shorter name. But although in these days, calling yourself Alex can cause you all kinds of problems with Amazon IoT devices. Yes, they keep waking up on you. But in any event, I'm sure that, basically they probably didn't go through this process. It just looked like something shouldn't be income. She didn't do anything to earn it. Well, she was right if she had only been born about 30-some years earlier. Minor detail. Now let's talk about the regs that came out under Section 451. The Tax Cuts and Jobs Act added two new provisions to Section 451. They added 451B, which is what we'll talk about, the revenue conformity rules, and they added 451C, which was an attempt to codify what was a revenue procedure and essentially make it the only one of two alternatives of how you're going to tax advance payments. The first thing I want to look at here, because I think it's going to affect more people that listen to this broadcast than the second, will be the advance payment rules. And this is proposed reg, so it's Regulation 104-554-18, published out on the 9th of September. We got it on the 9th this week, and actually last week. And what it does, Congress sought to codify Revenue Procedure 2004-34. That particular procedure deals with payments that are received in advance of when they would otherwise be considered includable in income, and you're on the accrual basis with the all events test. Bottom line, generally under tax law, if you've received this money, you have no requirement to return it. You simply have to fulfill the contract. You get to keep it as long as you deliver the goods or services. You had to pick that up as income. Now, obviously, GAAP doesn't quite think that way. And we've actually had a change now with ASC 606, which will impact us on other issues, including this one. So for GAAP purposes, you might exclude that from your financial statement income, but for tax purposes, you had to pick that up generally, or there was at least a long discussion. So what the IRS did was issued Revenue Procedure 2004-34 back in 2004, and that gave us an option that allowed us to do a partial deferral. Okay. Now, this rule is now being brought effectively into the law, well, kind of, and then the IRS brought the rest of the ruling in via the reg. So we'll talk about how that works. What the law tells us is if you have an Apple financial statement, and we'll talk about what an AFS is, we talk about revenue conformity, but if you have an AFS, then you have to record revenue for the year you receive the good, if you elect to use this method, at least as much revenue. You have to record revenue equal to the revenue recorded in your AFS. So whatever your AFS showed, if you got $200,000 as an advance payment, and on your applicable financial statement, $40,000 of that was in income this year, you pick up $40,000. The other $160,000 gets deferred. However, the rule provides this: that other $160,000, regardless of whether it comes into your financial statement income the following year or not, we'll have a caveat about short years here in just a second. But regardless of whether the next year, maybe the next year on your financial statement, you only got to pick up another $60,000 of the income. That doesn't matter. You're going to pick up the whole remainder in year two. Year two, all the rest of it comes into taxable income. No matter what your financial statement treatment is, if you get a payment, you've got to recognize in the current year or the immediate following year. Now, for most of us, because most of our customers are not going to want to pay us 5 years ahead of time, so for most of our clients, this is going to cover their situation and bring it into line with their GAAP financial. So that's great. The proposed regulations look mainly to the prior revenue procedure for guidance. So here's the catch. If you've been using RevProc 2004-34, and if you have advance payments, you should have been aware of that. This is not really going to change a whole lot. You're going to keep going down the same path. The major change you had was when ASC 606 came in. If that changed the timing of revenue recognition for GAAP purposes, then you had to go through the automatic revenue procedure change, which actually is one of the odd ones. It doesn't require 3115. But you had to go through that mechanism to allow yourself to move to 606 and pick up your income under the 606 rule instead of the old 605 rule. Those of you who don't do GAAP financial may wonder what I was talking about, but you probably have heard that we've changed our way of recognizing revenue. And the old method is what's now called ASC 605, which is Accounting Standards Codification. The new one is ASC 606, which is, essentially our new revenue system. Now, this particular case, the reg makes clear. The law says this is the only method acceptable for deferring revenue. If you meet these requirements. Now, to meet these requirements, it has to be amounts that would otherwise be an income under tax rules. So if otherwise you would have to include this in income under tax rules, this is the only way you can argue to push anything forward. You have to meet the requirements of 451C and the regulations under it. Okay? So that's key for us to remember. We can't argue for other methods. There are a whole series there of items that are included. They give you a list of a ton. I think it's about 13 items. It includes if the payments for services, sales of goods, that covers most things. If it is a use, let's say, including by license or lease of intellectual properties, including copyrights, patents, trademarks, service marks, trade names, other intangible property rights, occupancy or use of property that's ancillary to the provision of services like a room in a hotel, campsite space, mobile home park, recreational banquet facilities, sale, lease, or license of computer software, guarantee or warranty contracts ancillary to an item that's been described earlier, subscription in tangible and intangible format other than those for which an election under 455 is in effect. And those of you in that area should know what that is, right? Otherwise, I'm not going to spend time talking about all these. Or a membership where you don't have an election under 456 to recognize revenue. It's something called an eligible gift card sale, which has a little bit special rules. Any other type of payment that the IRS may add via later guidance that they have published in Internal Revenue Bulletin, so you don't have to go back to the reg. Or any combination. If you're selling any combination of those, you can use this method. Things you cannot use for, generally you can't use it for rent. You can't use it for insurance premiums. You can't use it for payments with respect to financial instruments, and payments with respect to service warranty contracts, for which you use the accounting method in Rev Proc 9738. If you have payments to a warranty or guarantee contract where a third party is the primary obligor, payments subject to various foreign income rules under 871A, 881, 1441, and 1442. Any payments which Section 83 apply, which is property transferred, performance of services, right? Any payments received in a tax year earlier than the tax year immediately preceding taxable tax year of the contractual delivery date for the specified good. So in essence, that is, there's got to be a delivery date the next year. That's kind of what we're going here. Okay, so we have these particular issues that we get there. Now, a gift card sale, those qualify if, right, if you have advance sale of a gift card or gift certificate, if the taxpayer is primarily liable to the customer holder of the gift card for the value of the card until redemption or expiration, and the gift card is redeemable by the taxpayer for one of the things for which we could have deferred had we gotten a direct payment for that item. So again, with a gift card, I don't know what you're going to do. Right? I may have got a gift card at Best Buy, bought a gift card. Best Buy sells me a gift card, right? Well, I could use that gift card for any merchandise at Best Buy. They're not under an obligation at this moment to deliver, let's say, a Samsung 55-inch television. If I present the card and say that's what I want, they're under an obligation to deliver that, but they have no specifics. You can still use that. Okay? That's going to be the key issue. What we can still use, what's still there, are eligible gift card sale. Now, if you have an AFS, couple of issues there, right? We have this, some for with AFS, and then special rules for those without. Interesting part about the without is the law itself only mentions AFS, so this is kind of unique, but the IRS said they meant to get the old Rev Proc in. The old Rev Proc had for AFS. We don't want to have a Rev Proc for those without an AFS and a reg for those with, so we're going to put it all inside the reg. Okay, that's how we're going to do it. What's an Apple financial statement is the same as it is for the conformity rule. We'll talk about that here in just a second. And again, you can only elect to use this in cases where otherwise the tax rules would basically allow full inclusion. So you can't use it for something where it wouldn't otherwise be an income, right? That would be key. Other characteristic of this rule, if the following year is a short year of 92 days or less, a special rule applies. So I've got, let's say, a year, this year ends in December. Next year, I decide I'm going to switch my fiscal year in to February, allowed to and do so. That 2-month year is actually going to continue to be treated as if it was the year of receipt of the payment. I only recognize during that year revenue up to the amount of what I recognize on my AFS. I don't worry about the rest of it. The following year then, so now this would be the year ended, that 2-month year is year ended February 29th, right, of 2020. The year ended February 28th of 2021. That's the year when I pick up whatever I haven't picked up yet has income. That will be my second year, even though it's going to be the third year impacted. That only applies 92 days. If I change my fiscal year to be one that ended, let's say, in April, so now I've got this April of 2020, this year going from January 1st to April 30th of 2020. That year's, in that case, I have more than 92 days. And so in that case, I would have to treat that year, the 4-month year, as my year 2 in this. There's also some special acceleration rules. Generally looking at when the taxpayer kind of disappears, like the taxpayer dies, ceases to exist. If any of those things happen, where we have those issues, generally what's going to happen is we're not going to let you use this method. You're going to have to pick up the entire advance payment because our problem is there really is no second year. So there's not going to be another year to pick this up. That's going to force matters just a bit more. Right? That's our 92-day rules. If we have a gift card, right? Special gift card rule. If the gift card is redeemable by another entity whose financial results are not included in the AFS for this taxpayer. So let's say I could use my gift card. I can use it at Best Buy, but it also provides it could be redeemed at another related party, but a party that's not in the AFS. Then what happens is a payment's included in my AFS to the extent the gift card is redeemed by that other entity during my tax year. So if you sell it, it's not redeemed at Best Buy, but it is redeemed during the tax year at that other vendor, even though that other vendor may not submit for payment till the following year, I'm still going to have to pick that up if I'm Best Buy in the year I sold the gift card. That's when I have to pick up my revenue. If you don't have an AFS, a little bit of different rules in this case. The basic rule is you have to be able to determine when revenue would have been recognized under the regular tax rules, in your situation, if you had not received advance payment. So let's assume that you had not been paid in advance, your accrual basis. When would you have basically have considered to have the all events test take place? Now, a lot of times that's going to be on product delivery, but there could be other situations, different accounting methods you need to pick that up. And again, whatever didn't come in the year you received the payment goes in the following year. You end up using, the IRS does provide that to determine how much you pick up in the current year. You can use it, a couple of methods. If you're unable to determine the extent otherwise, first thing is, if you can tell when you would have picked it up, you have to do that. But if it's difficult, let's say you sell a whole bunch of these things, it's going to be difficult to determine. You can use a statistical sample, if adequate taxpayer data is available, or you can do it on a straight line basis if you receive advance payments under a fixed term agreement, and it's not unreasonable to anticipate the end taxable year of the receipt that the advance payment will be earned ratably. That one requires a few, shall we say, additional assumptions, or an other method that's found acceptable by the IRS, which means you got to argue for that when the exam comes. You may or may not like that, but that's kind of how it works. Now, if there's any change in timing for recognition, including one that maybe is mandated by FASB, that's an accounting method change, and that's been true before. We went from ASC 605 to 606, and you were under the old RevProc. You had an accounting method change, Change of timing, the whole issues come into play. You had to go check your automatic method rules. The thing to remember is right now those are pretty simple, but you have to go keep checking. And by the way, the IRS, at the same time these regs and the ones we're going to talk about next were issued, they did issue a separate revenue procedure to allow you to get automatic change for the first year under these rules. So if you're having to change to go to these methods, you want to make sure you double check that you're complying with that new procedure, because that procedure came out right here. In these cases, Revenue Procedure 2019-37 has the automatic change rules. Finally, this week, let's take a look at the conformity rule. This is Reg 10-104-870-18, issued same day on September 9th. We have the 451B. This is the Revenue Conformity Rule. And what the Revenue Conformity Rule, it applies to taxpayers who have an Apple financial statement and who are on the accrual basis for tax purposes, accrual method, I guess I really should have said, accrual method for tax purposes, overall accrual method, and are including income based on the normal all events test. So if those three things apply to the taxpayer, there's an AFS, they're using overall accrual method, and their all events test, then we have to worry about this rule. It does not apply otherwise. Okay. Now, what this is going to force us to do is recognize revenue on the tax return at least as early as revenue is recognized in the AFS. So the idea is Congress did not want to be embarrassed by having front page headlines come up in various publications and be on, news things in the evening and on news shows saying that company XYZ, had essentially recognized $2 million of revenue for sales, but they're not recognizing that for tax purposes until 10 years from now or whatever. They don't want those stories. They're trying to get rid of that. So they put this rule in place. Why with AFSs? Because AFSs are the type of taxpayers whose information is out there to somebody else, which means, let's be honest, the news media is most likely to be able to figure it out, that there's been a mismatch of timing. So voila, again, we're going to keep it out of the newspapers. Again, nothing in the law says that, but let's be honest, that's, if you're a congressperson passing a law, this is what you're thinking of. I don't want to be embarrassed that my tax bill is doing this and I didn't realize it could do it and now I'm being embarrassed, and I don't want to be embarrassed. So we're just going to start going down this route. Now the obvious first question, because you have to have one of these, is what's an applicable financial statement, an AFS? Well, generally, we go in order. And we're going to test first our GAAP statements Then if we have them, if we don't get a GAAP statement that's a AFS, we'll check our IFRS statements. And if we don't have an IFRS statement that's an AFS, we probably only have a GAAP or an IFRS statement, so we'll flip whichever one. We might have both, but most likely we only have one. And then we're going to check to see if any other statement maybe comes in. So what's our test here? We're going to check. First thing is we're going to look for anything we file with a 10K or successor form, or an annual statement filed to shareholders with the SEC. If we're in the IFRS test, you're going to look for a similar regulatory agency in another country that has similar powers as the SEC. Do you file with those? Okay. If we don't have one of those, then we're looking for an audited financial statement that's used for a substantial non-tax purpose, which would include credit purposes, reporting to shareholders or equity holders or beneficiaries. I don't know very many taxpayers are going to have an audit performed simply because, hey, I just want to do an audit. I have no reason for it. I have no non-tax purpose for doing it. But this was written that way, to be totally honest, simply to help us avoid from having taxpayers who might want to go ahead and get an audited statement to maybe get some sort of tax advantage out of this. Not sure how you're going to get an advantage, but we're going to stop you from there. And then finally, a financial statement other than a tax return filed with the federal government, any federal agency other than the SEC or IRS. Okay? You'll test your GAAP statements for that. You'll then go on and check your IFRS statements for that. If you finish both of these, you still don't have an AFS because, by the way, a reviewed statement is not an AFS. A compiled statement is not an AFS. Obviously, a financial statement preparation by an outside CPA is not an AFS. And one you do internally. If that's the only thing you've got, don't otherwise fall in the trap, it's not an AFS. Well, the final test, if we don't have any of those, will be a financial statement or a tax return filed with any sort of state government agency, federal government agency, federal agency, state government agency, or state agency, or self-regulatory organization. They also added that the IRS could add additional entities, additional type of things you file it with in the Internal Revenue Bulletin. So you test for that last category. Okay, if you have one, then the question becomes, okay, first thing is, are we on the overall accrual method? Let's assume that's a yes, because obviously if you be on the cash basis, you get out of this. So then we just take a look, well, are we under a method that does not really use the all events test or is separate? And there's a whole list in our materials of things that are not considered to be subject to the all events test or going to be considered not part of this. One of the big ones that kind of comes into play is any of the long-term contract rules under 460. That includes percentage of completion method for construction contractors, includes any of those specialized methods. The installment basis, if you can report for that. If you qualify for that reporting, that also doesn't because that's separate and apart. So we have this long list of special rules, rental payments under 467, mark-to-market under 475, all of these special rules which are not impacted. Okay. Now, it really goes ahead and it uses a lot of language from the new 606. So if you're into A&A, you're going to see a lot of 606 related language and issues discussed in the regs. You want to go take a look at those. One of the big things that got a lot of people upset about this is there is no cost of sales matching. A lot of people were pushing the IRS to say, hey guys, if we're going to have to recognize the revenue, $100,000 of revenue, then we should also be able to recognize the inventory costs, the cost of sales. We should be able to run that through at the same time. The IRS declined to do that in these regs, holding that the law itself says nothing about that. They did, however, open up the question that maybe they should allow percentage of completion method to be used in more situations. The theory being ASC 606 may have gotten taxpayers into a position where they're going to start using what's going to be an input method for recognition of revenue. So we have the input methods, output methods, those sorts of issues, recognition of revenue outside of construction contracting. And in those cases, the IRS is thinking that could present a real major problem under these rules because, if you're going under that method and recognizing expenses right away on GAAP, but for tax purposes, we're still treating this as not a done sale till the whole thing's completed, then we got a problem because we're going to recognize that revenue because GAAP's picking the revenue up, but we're not going to get deduction for the expenses until, potentially years down the line. So they're asking maybe they should expand 460's tax PCM rules. Now realize tax PCM rules are not the same as 606's rules. They're if you use input methods, they're close, but they're not the same. If you're using output methods, they're not going to be the same at all. So tax PCM is cost to cost. And there are certain costs in tax PCM that won't be in GAAP. So yeah, we got to kind of look for that too, which things are there. But they are considering opening up 460 as an option. And if they opened up 460, you at least get the expenses based on 460. And generally 460 is going to accelerate you faster. Well, not in all, but in many cases would accelerate the revenue faster than the GAAP method. So that's going to be kind of an odd trade-off if they do open it up. But they have not opened it up yet, so that's still not a possibility if you're in that mess for this purpose, right? Now they note doesn't change overall tax accounting treatment. If tax accounting has a way of calculating revenue, including revenue, you're still going to use those treatments. We're not changing the treatment, we're changing timing. There are a series of special issues. There are special rules to tell you what happens if your applicable financial statement covers a group and how you separate it out. If there's a difference between the tax and the AF areas you're in, they tell you how to deal with that. Hopefully you'll be able to pull in and get things out. If you say our records aren't good enough, they remind you that under the Internal Revenue Code, you're required to have good enough records to do this. So if you don't, you're out of compliance with the law. That's kind of bad. They have special rules if there are restatements. Generally going to you're going to catch up revenue to date and make sure revenue to date GAAP and revenue to date tax are in sync, or at least revenue to date tax isn't behind revenue to date GAAP. They also tell you if there's an accounting method change, even if FASB requires it, you've still got to go get IRS permission. Different rules apply to debt objects. I won't go into them in detail here, but you should be aware of they're there. If you have an adjustment to deferred revenue for financial statement purposes and you run it directly into retained earnings, that's going to be considered income or revenue for the year you make that movement. That's part of your deal. For multi-year contracts, cumulative rules. So again, we're going to always take a look at cumulative revenue, not just revenue for that year, and make sure cumulative records are in place. I already told you about the accounting method changes cause an issue, and they have not yet provided any guidance for AFS inclusions for foreign persons or foreign entities, right, that are in there that might have a kind of like once removed problem. So there's still going to be some additional guidance we're looking to issue there. Kind of a mess. If you're covered by this, the good news is most of us have clients not covered by this. You're not covered by this if there's no audit. That's probably for most people listening to this who are CPAs. Your probably number one question for most of your clients is going to be, who do we audit? Do we have an audited statement? Then number two, if we don't have an audited statement, do we file any statements with government agencies? If the answer to both of those are no, your client can ignore 451B. If your answer either one of those is yes, you're in the game. Oh, by the way, it's a year-by-year test too, so you could be in and out. Gets a little weird on that. Certainly it's an issue if a blender wants an audit. Now you've got to tell them that client has to realize this could be part of your cost. It'll be interesting to look at. Remember, if you are below $25 million, an out is literally to take the cash basis of accounting under the special accounting method rules, because cash basis taxpayers aren't covered by this. So some issues if you have a client covered by this, and we all hope that you don't have a client covered by this and you have to file the return because they're an S corporation or a partnership, and you're probably listening to this on the day the return's filed or listening to it after the return's filed. Yeah, it's kind of a mess. We didn't get our guidance till this late. Well, again, remember, don't get left behind. Your CPE's coming up after October 15th. You're going to have a bunch of issues. We've had lots of changes. The IRS is issuing regs now. The regs are running again. Like I said, we have, which we'll discuss next week, regulations under the bonus depreciation rules went final. We have these proposed regs. There'll be a set of finals that'll come out on this. We expect other projects to come out that'll have regulations on them. All of these are key. You need to keep up. I would suggest you take a look carefully at trying to get up to speed, finding your proper continuing education in the tax area for the last part of this year, because there's a lot of things happening. They're going to continue to happen. We seem to be getting the guidance now, which is going to be coming fast and furious, and you need to know this guidance in order to help your clients plan for this year's work, what you can do so far through the end of the year, as well as do the standard compliance work for next year. This has been the Current Federal Tax Developments for September the 16th, 2019. You can check our online site, currentfederaltaxdevelopments.com. There we'll post information about developments as they occur during the week. You can also follow me on Twitter. My address there at Ed Zollers. If you have questions, you can email me, edzollers@currentfederaltaxdevelopments.com. You also can follow me online. I do participate in the Connect groups for the Arizona, Minnesota, and New Jersey Society of CPAs. I also check in from time to time to the Reddit group at /r/taxpros and Cal CPA's Tax Talk group, which is open to any CPA or attorney licensed in any state. You just have to go to Yahoo Groups. You have to search for Tax Talk, and you have to get permission to be let in, but that shouldn't be a problem. Check there. Those are great places to check to see what's happening, what's going on. Otherwise, next week I expect to be talking to you about the proposed regulations and final regulations on bonus depreciation, plus anything else that might come up during the week, because there's a lot happening. So take care. Hopefully you got all your partnerships and S corporations filed, and now you're thinking about all those trusts. And we'll see you next week as you're in the middle of finishing up those final trusts, in the middle of all that, heading to that deadline. And join us for current federal tax developments.